somebody comes and sees you today, and I'll jump in on this one as well and says, all right, talk me through variable versus fixed and what we should be doing. What are some of the things that come to mind that you talk to your clients about?
It's a conversation that I have had probably 2,000 or 3,000 times, and I wouldn't even say I've perfected the response to that as to whether a person should fix, how much they should fix. But I have come down to probably one core reason why people should fix a rate, and that is because they want certainty over their repayments. But they see the rate now and they want certainty over that repayment level, and that is pretty much the only reason to fix. We would easily have as many people who have fixed at a rate that's too high than is too low. As soon as a client thinks they want to fix because they want to beat the variable rate that they might be paying, as soon as they feel as though they want to beat something and have a win, at that point we are entering an unknown territory, which is not far off going to the casino and putting money on red or black. That bit is a gamble, and I try and steer people away from that. The only reason they should fix is if they want certainty over their repayments.
Yeah, I heard I can't remember where I heard this from before, but this particular gentleman said, think of fixed rates like an insurance product, all right? So, and I think he might have been in the finance game at some point, and he sort of came across some research that suggests that if somebody just continually fixed over a 20-year period, that they would probably pay a premium over if they just went variable, all right? So, but that's okay because it's like an insurance product, right? Insurance costs money. And I think we've just come out of this season where, because rates have been either coming down or low for a long time now. Like it's been 3, 4, maybe even 5 years where we've been on this journey, and so there's a whole range of people that just don't actually know what it means for rates to go up.
I think the last RBA increase, it's getting on 10 years. Yeah.
Well,
so, I mean, some of our first home buyers, which might be 28 or 30, may not have had that experience, as you say, in their whole adult life. And, of course, their parents, who may have, had their first home purchases in the mid-'80s and have experienced 15, 16% rates, it doesn't even take one whole generation to experience the two complete extremes of the interest rate fluctuation or cycle.
And I think for me as well, it's also taking into consideration that it's about the repayments, but it's also about, how much do you think you're going to be able to pay off the mortgage over the next 5 to 10 years as well, or not that long, 3 to 5 years, because, there's a bit out there in the media talking about, possibly wages going up a little bit over the next 6 to 12 months. So possibly people are holding on to a larger than normal amount of savings, and they need to be able to put that somewhere. And that's one of the things to be careful of as well, that you go and fix all of your loan for a long period of time and you're taking away from that ability to knock a big hole in the mortgage, aren't you?
Yeah, that's true.